the economy is going to collapse or fall into recession. So the markets are completely ignoring what is likely to happen. And while they still are looking in the rearview mirror at a playbook that is basically obsolete, they're not doing what they should be doing. They should be buying gold when they sell treasury. They should be selling dollars when they sell treasuries. After all, what the hell is a treasury but dollars? In fact, they're worse than dollars because they're not dollars today. They're dollars in the future. They're IOUs. They're commitments of the U.S. government to give you dollars in the distant future. Well, who knows what those things are going to be worth in the distant future?
The Federal Reserve's monetary policy is broken. Normalization of interest rates has been needed for years to allow markets, not regulators, to allocate capital. But with interest rates at 5.5% and the dollar strong, the inflation battle must shift to the problem of government spending and regulation. The Fed's silence on the fiscal and regulatory roots of this inflation crisis and its insistence on using an antiquated inflation model that blames growth and jobs for price hikes risks an even weaker U.S. economy. Peter Schiff strongly believes that the economy is on the verge of a collapse or a recession. Schiff notes that despite stubbornly high inflation levels, the Federal Reserve believes inflation may ease. This expectation of reduced inflation has supported the dollar and suppressed gold prices. However, Schiff argues that investors will eventually realize that inflation isn't going away as quickly as expected. He asserts that this is not a sign that the Fed needs to increase its efforts to combat inflation, but rather an evidence that the Fed has already lost the battle against inflation. Federal Reserve officials have signaled ahead of their next policy meeting this month that they can move slowly in their fight against inflation as the labor market softens and prices tick down from pandemic highs. That could mean a pause this month. But they have also warned that may not mean the central bank is finished raising rates. At this stage, I believe we must proceed gradually, weighing the risk that inflation will be too high against the risk of dampening the economy too much. Federal Reserve Bank of Dallas President Lori Logan said in a speech September 7th before the Dallas Business Club. Peter predicts that investors will eventually face the reality that the low inflation rates of the past are no longer attainable, and inflation is likely to be significantly higher. This realization, he believes, will lead to a substantial increase in bond yields. We will now bring you clips from Peter Schiff. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think that you're going to see a break from gold and bonds. Now, part of that is the dollar. I said that bond yields rose for 5 weeks in a row. Well, the dollar rose for 5 weeks in a row as well. The dollar is going up with bond yields, but that's not what should be happening. And eventually, this is going to decouple. I think that you're going to see the dollar and bonds falling together because the real reason that bonds are weak is because inflation is strong and going to get stronger. See, right now, people still look at the inflation data and the fact that it's stubbornly high, and the Fed is now concerned that it might rear its head as if its head ever disappeared. But, they were talking about inflation coming down. It went down from 9 to 3, but now it looks like it's going back up. And so the markets are looking at the resurgence in inflation, and their conclusion is, okay, the Fed's just going to have to fight a little harder to win this battle. It's going to have to raise rates a little more and keep them higher for longer. And that mentality has been propping up the dollar and suppressing gold. Now, the dollar hasn't made a new high. Gold hasn't made a new low, but it has keeping a bid in the dollar, and it's keeping pressure on gold. But eventually, as I've been saying, investors are going to have to realize that inflation sticking around longer than people thought. The fact that they can't slay this beast. This is not an indication that the Fed just has to fight harder to win. No, what we're seeing is proof that the Fed has already lost. Inflation won. The Fed can't possibly raise rates high enough to reduce inflation without crippling the economy, without creating a worse financial crisis than 2008. This fantasy, though, is still out there in the market. But at some point, the investors are going to be confronted with reality. And that reality is those days of really low inflation, they're gone. We're not going back to 2%, not even close. We're going to be much higher. And that's why you're going to see a much bigger backup. What if the Fed can't lower interest rates, even if it wants to, because inflation doesn't go down? And in fact, it may start cutting rates and have to abort it because inflation takes off. Because the minute they start cutting rates, the dollar falls through the floor. Because I think it's getting ready to do that. I don't think there's any real support anymore, other than the talk about higher rates and the belief that the inflation genie is going back in that bottle. But when the reality sets in that that's not going to happen, that we're going to have historically high levels of inflation, the yield curve is going to normalize. In fact, it's going to be steeper than normal because inflation is going to be accelerating even faster than normal. So when we go back to those days, then if you have a 5.4% yield on a 90-day bill, then you're going to have 6%, 7%, or more. And we may not stop in the fives. The Fed may have to keep hiking short-term rates. There's a lot of risk for rates going much higher than people think.
As the economy is on the brink of a collapse or recession, Peter contends that inflation could be the catalyst that triggers this downturn. He highlights that if inflation is the problem during a recession, the Fed cannot resort to rate cuts because doing so would exacerbate the inflation problem, leading to a further deterioration of economic conditions. In other words, Peter argues that the Fed's traditional playbook of cutting rates during recessions would no longer be effective, and this would put the Fed in a checkmate situation. The Fed will hold its next policy meeting September 19th and 20, and officials are expected to hold rates steady in the range of 5.25% to 5.5% to see if the inflation data continues to show cooling. Inflation has dropped from a high of just over 9% to closer to 3%, but on a core basis, stripping out volatile food and energy prices, inflation is still running around 4%, twice the Fed's inflation target. According to Peter, this will result in a bond market crisis, which is usually seen as a safe haven during economic turbulence. Consequently, the stock market, which often benefits from rate cuts during market downturns, will also be adversely affected. Let's get back to the interview. Now let's add the video here.
The economy is going to collapse or fall into recession. That's what all the bond bulls are betting on. They're betting that when the higher rates finally take their toll and create a recession, that the Fed is going to do what it's always done and cut rates. But what if inflation is not low? In fact, what if inflation is higher by the time we officially enter recession? In fact, what if it's higher inflation that is the catalyst to cause that recession? The Fed can't go and cut rates if inflation is the problem, because cutting rates will make that problem worse, which will actually sedate the economy that the Fed is trying to stimulate. In other words, it's checkmate for the Fed, right? The game is over. It can't do this anymore. The only way it got away with this stimulus in the past was because it was able to pretend that we didn't have enough inflation and that it needed to get the rate up to 2%, its made up target, right? Well, if it's already way above 2%, they can't play that game anymore, right? They can't, get away with that BS because no one's going to buy it. And so the bond market is going to get killed, and that's going to be a big problem for the stock market, because one of the reasons that the stock market gets saved, right, whenever the stock market goes down because of problems in the economy, problems for earnings, well, the Fed rescues the stock market by cutting interest rates, which now pushes up stock valuations and, of course, drives more people into the stock market because they can't get any yield in the bond market. Well, that's going to blow up too into the future. So when people really start to put the pieces together, the bottom's going to fall out of the dollar. That's going to be even worse for the bond market. And it's going to, explode the price of gold. So in the meantime, you've got this opportunity, as I've been, pounding the table on, to buy more gold and silver. while you can, while the prices are still low. In my opinion, they're very low.
The U.S. Federal Reserve Chairman has said the central bank will continue to raise interest rates, if appropriate, as inflation remains too high. The Federal Reserve has raised interest rates to their highest level in 22 years in an aggressive bid to curb inflation, and there's a chance that more rate increases may still be on tap if the economy's strength causes inflation to rebound. What are your thoughts on the current state of the economy and the challenges it may face in the near future? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.